Well, hello, everyone. I'm James Tarkenton, Senior Portfolio Manager here at Townsend Asset Management. And this is our Capital Markets 2021 discussion. We are obviously, with the world's goings on, we are changing things up a little bit regarding format. So I'm going to walk through, for some of you that have been coming to the presentation and maybe fretting having to listen to an hour's worth of PowerPoint slides and me talking, that is not going to happen. We are going to go through a couple slides. And then the reason I'm sitting in our conference room, I'll be using the whiteboard behind me about halfway through the presentation to walk through some other points and topics, just trying to change up processes here a little bit. We are going to keep it still to about 30 minutes, just like we've been trying to do with all of these to, one, keep you engaged, but then two, also respect your time. But I can say that given the change in format and as always, plenty of things to talk about, we can commit to doing another one of these in another few months to review what we talked about today and what other topics that may be on people's minds at that time. But I'm gonna go ahead and share my screen with you and walk through a few slides here. Okay. So we're gonna briefly walk through where we've been. It's been a heck of a 12 months, that's for sure. I was reflecting the last time we met regarding this meeting. I believe it was the first day of the sell-off and the realization that there was something here that we needed to pay attention to from a global pandemic standpoint. We'll talk about some valuations and where performance has come from and where we think we can find it going forward. We'll talk about the Fed, and then obviously with the Fed interest rates, make a few comments about stimulus, and then lastly, touch on the threat or the fear or the management of inflation concerns. So here we have the stock market performance as measured by the S&P 500 going back to January 1, 2016. Obviously, you see the pullback in February, March, April. Well, I guess the end of March was the low. It's worth repeating that it was interesting that it was the fastest number of trading days to a bear market in the market's history to be immediately followed with the fastest return to a bull market. Also shown here is the election. We spent a lot of time talking with clients about the election and some concerns. We've in the past on this presentation tried to show kind of historical performance for the markets on an election, regardless of party, that is the winning party. And not only had the performance averaged to be positive, they've actually averaged double digit positive. And it certainly shows here in the example of one that the market seemed to look through the election and has continued to advance. I think interestingly, in 2020, the NASDAQ was up 44%. We have set 32 record highs so far in 2021 across the S&P, Dow, and NASDAQ. The NASDAQ has set 12 of those records on its own. And for the last 6 months, small caps are up 44%. So definitely a consideration that we're going to come out of this and things are going to return quickly to where probably they were. If you talk about price performance, you need to talk about valuation. So this is the historical S&P 500 price earnings ratio. And I think the most obvious thing to notice is that the current 22.3 is at least approaching what everyone knows was the tech bubble back in 2000 of 24.5. I think what isn't considered or what is overlooked at times just from the absolute number is that the contributions to the price earnings ratio, mostly the price or an expectation of earnings is completely different than it was back in 2000. And that's really driven by the Fed and where rates are and what people are pricing in. Each year we try to at least remind investors of that things don't always just go straight up. This is by year the number of 5% pullbacks. So not a 5% pullback, the number of 5% pullbacks in any given year. If you look, 2012 forward, short of 2018, the volatility was pretty muted, and almost jokingly, in last year's presentation, must have said increased volatility 150 times. It was the Townsend topic of 2020, and we'll get to the Townsend topic of 2021, but we certainly had a volatile year last year with 12 5% pullbacks, tying for third, and half of the 2008 great financial crisis. And just to the point that at least so far, there have been none in 2021. Just to look at where rates are, these are Treasury yields, the 10-year versus the 2, or not versus, it's the absolute 10-year in blue, and the 2-year Treasury in orange, yellow, whatever that color may be. And as we'll talk about a little bit later with the whiteboard, the market, at least over the last few trading days, has become a little bit concerned with the pace at which longer term rates are increasing, with the concern about inflation. But it's never about what the absolute number is. It's always about the path and what the pace of that path is. And like I said, we'll talk about that in a second. But if you look at where rates are, at least to historical means, we're certainly still at incredible low numbers. Here we have the Treasury yield curve on 3 different time frames. The blue line is the latest measure. The orange/yellow line is 1 quarter ago, and the red line was 1 year ago. And it's almost like a broken record, but I say it every year that, every time we sit down and have this discussion, there's going to be a list of concerns that I guarantee you we won't be talking about in the following year. And, last year we were talking about inverted yield curves and what that meant for the economy and stock prices. And now we certainly have a steepening yield curve and more traditional yield curve, which at this point is arguably a good thing, showing that, the market is expecting an improving economy. Here we have corporate bond yields through time at various investment grade classes. So corporate bonds are rated by default risk, with AAA being the highest credit worthiness and CCC being the lowest, at least on this graph. Investment grade bonds are BBB and above. Non-investment grade, i.e. the highest corporate default risk, is below BB. And while you're still getting paid 7.2% for a CCC bond, I would argue that nowhere here are you being paid for the credit risk that you'd be taking. The Fed is definitely telling you that if you want to make money, you got to go somewhere else beside the corporate bond market or the bond market in general. For illustration, we have the Fed funds rate. You see that it's basically zero. Our friend Jerry Powell, when you know him as well as we do, you call him Jerry. He made comments last week about how the Fed was going to continue. The discussion about rates has picked up, and I'll illustrate why. But he definitely, in one of his presentations to Congress, reiterated the accommodative nature of the Fed, regardless of what had happened to rates recently, and the potential of increasing Fed fund rates anytime soon. These are, I think, interestingly, if you look on the graph here, you see that 2021, 2022, 2023, there is no expectation that that's going to occur. But their goal is 2% inflation, which means Fed fund over the long term, which means Fed fund rate will have to work its way back there. Again, it'll be when and what that pace is going to be. That'll be the driver of the discussion. Here we've got global central bank balance sheets. Globally, central banks are being very accommodative given the pandemic. Our Treasury is spending about $120 billion a month buying treasuries and mortgage-backed securities. Essentially, the purpose of that is to drive liquidity, putting more cash into either the government or banks for them, ideally, to go do something with that to drive economic growth. That obviously never been at this level before. Many discussions on how we reverse this and what it will mean. It certainly is yet to be seen. I guess given the recent headlines, I think it's just encouraging that we haven't heard that one of the assets they've been buying is Bitcoin. But anyway. So the next few slides, if nothing else, I think are interesting, but it does give a backdrop of why we think that, as the vaccine becomes more penetrated or, is more widely administered, that there's a obvious pent up opportunity in the marketplace, and it'll be interesting to see the pace of which it comes back. But this is consumer spending year over year. The blue line is the consolidated retail sales number, growing at about 7.4% versus the average of 4.2. The orange line is non-store retail sales. And I think we can all relate to noticing the collapse of the number at the start of 2020 as everyone stayed at home, and the immediate reverse reaction in non-store sales. It'll be interesting to see where this settles out going forward, the appetite to roam around a mall and brick and mortar stores versus how used to and how comfortable we become buying things that we typically didn't buy online, and having them, managing lives to where, you're getting these items maybe a day, 2, or even 3 days before you realize you need them. I think one takeaway from an equity standpoint on something like this in a Townsend portfolio is a holding like Visa, which is going to obviously participate in the higher penetration of plastic in transactions than paper. Here we have the personal savings rate. It should be obvious that people have very solid personal balance sheets. It's the current rate is 2 times the 20-year average. And I think interestingly, 65% of stimulus payments so far have gone in either savings accounts or been used to pay down debt. Both improve the liquidity and creditworthiness of individuals. And I think it shows that there's quite a bit of money lying around for when people have the opportunity to go spend it. Another just interesting slide. This is the number of daily travelers through TSA checkpoints. Before all this started, you're well over 2 million a day. Clearly a massive decline as air travel was shut down. But, even as we, start to come back, we're still 1/3 of normal traffic. There's a term that's been used, bleisure travel, where, it's trying to gauge the level of business travel returning to where it was, and that the thought that most people would combine leisure travel with business travel to get bleisure travel. But clearly, upside to potential traffic and traveling and all that goes with that. And then lastly, last slide of the presentation, restaurant activity. So this has 4 lines. It's represented by 3 states and the US average of the 5-day moving average of reservations made through the OpenTable restaurant reservation software system. I think it's astonishing to realize that this graph starts at 0 and just goes down. Obviously, the period of time where there were actually no reservations made whatsoever. But Texas down 35, the US down 47, California down 55, and New York down 73. We'll see these numbers improve here, as I'm sure you've all seen. Some restrictions have been lifted, including eating indoors in New York. I think the other interesting observation here is around that January 2021 timeframe. It certainly appears that a bulk of the nation was not paying attention to the CDC guidelines, and a number of people went out to enjoy the holidays with their family. But let me end there and start to use the whiteboard here behind me. Okay, let me get adjusted here. So we talked briefly about price and valuation and where do we stand now. And I always enjoy the acronyms and analogies and metaphors that are used in really any business, but certainly the financial industry. But you all are aware, probably. Let's see here. There we go. Of fame. That's obviously Facebook, Amazon, Apple, Netflix, and Google. Obviously, Google is Alphabet, but it doesn't fit the acronym, so we have to change it. Well, last year, 2020, Facebook total return 33%, Apple 81%, Amazon up 76%, Netflix up 67%, and Google up 31%. Just recently, with some additions to an addition to the S&P 500, a new acronym is being thrown around that I'm not so sure it's all that socially appropriate, but I only have to think they were thinking of me when they came up with it. Fat man. So our same FANG stocks, but with Tesla, which last year was up 734, and Microsoft, which was up 43. So essentially what the point of this is that with the market up a little over 18% last year, or the S&P on a total return basis, the bulk of it came from a very concentrated list of companies. And to show that, we've got totally not to scale, 18.2% for the S&P 500. We've got 5 stocks. Up a collective greater than 50%. And over here, 495 of the remaining stocks in the S&P 500 were up a collective 3%. So it's being aware of where the returns came from, but also making it obvious that there's selective opportunities. I mean, we should be able to find high quality businesses at good prices within that 495 stocks that were up 3% last year. It also should suggest to you that whether it's cash needs for you individually, or as we look to buy some new things, we'll certainly be pulling money away from, your growth funds or ETFs or even some specific individual holdings that made up some of these names. All right. One of the things we've been talking about over this time frame with you guys is concept of what low interest rates do to valuations. And we talk about how further out cash flows in a low interest rate environment contribute more to today's value than if rates were higher. It's the basic argument of $1 today is worth more than $1 in the future, because I can do something with that dollar today versus having to wait for an uncertain dollar in the future. Not only when I'll get it, but is it going to be the full dollar? And so, typically, some level of glassing over of the eyes occurs, and you can see that, the brains are starting to hurt, which appropriately so. Some of this stuff can get a little overwhelming. So I just thought maybe an easy example to show you what that can mean to equity valuations because of rates would be useful. So we're going to assume a 1 billion opportunity in 10 years. So 10 years forward, we're going to realize an opportunity, an investment, helping out the company, valuation company, but in 10 years. Now, typical times, you may question, how secure is this opportunity? How realistic are we getting the billion? How much do we have to put in? Is it a new business segment? Is it an opportunity we've never done before? Or just frankly, we're not so sure it's going to happen. So let's really only consider it if we really put a higher interest rate on it to show that risk potential or of not happening. Well, 1 billion, 10 years out, that's 20%. Today is worth $161 million. Okay. And then you could say, well, James, rates are really low. I mean, the 10-year treasury is at 1.5. Why would we, is there really that much more risk in this 1 billion opportunity to discount it at 20%? So let's discount it at 10. Rates are where they are. Got a great opportunity. Well, the only thing we're changing is the rate that we're discounting this money back to us today. So 10 years, 1 billion opportunity at 10%, $385 million. So you can see just changing the interest rate by half essentially almost doubles the realization. Now, lastly, the argument of CB, James, you're just flat out mean. You're unrealistic. The 10-year treasury is at 1.5. I'm not saying we should discount it at a riskless rate, but let's double it. Let's really punish them by doubling the rate that I could go get risk-free on this opportunity. So we'll discount 1 billion opportunity in 10 years by 3%. And all of a sudden, that $1 billion today is worth $744 million. Well, let's put it in some real world opportunities here and actually see what effect it would have on potential stock prices. And just for fun and for ease, I thought we would consider Tesla. So Tesla today has a $675 billion market cap. It has 1,155,000,000 shares outstanding. And you're going to put a multiple on these earnings. They're going to be worth, a buyer of that opportunity is going to pay a multiple on that. And just so that we don't, market's efficient, market is telling us what it's paying for the profits of Tesla, we're going to go ahead and use their price earnings ratio today of 1,124. So if you take this cash flow of 161 million that we're going to get in 10 years, that is $1 billion opportunity, we multiply it times the earnings multiple and divide by shares, This opportunity is worth $157 a share at 20%. So this is the important part. This is where the rubber meets the road. What does all this fancy financial math mean to the stock price? Well, this should suggest that this opportunity is worth $157 a share at 20%. At 10%, it's worth $334 a share. So purely by the interest rate again, nothing else. We've kept everything consistent and with today's numbers. And then lastly, discounting it at 3%, which is double the Fed, the Treasury rate, $724 a share. Tesla share price is $700. So simply by discounting $1 billion opportunity and using current multiples and discounting it at 3%, just because rates are low, that would argue that this $1 billion opportunity would double Tesla's share price. Is that realistic? I don't know, maybe. I don't want to stand behind that, but again, the purpose of this exercise is just to show you the financial math of discounting at lower rates and what that means for equity values. So let's talk about interest rates. I mentioned before, it's about path and pace. Well, path is the easy part. Interest rates are zero. We can only go one place. So we know we're going up. So the interesting part is going to be the pace. And that's where people are either going to be comfortable or get nervous. So where did we start the year? 12/31, 0.9% on the 10-year. On February 15th of this year, we were at 1.157%. 5 trading days later, February 19th, 1.344%. And at the end of last week, it actually crossed 1.6%, which ironically is the dividend yield on the S&P 500. So it's this acceleration from 0.9 to 1.6 that's getting people's attention in a matter of 2 months. That's why Fed Chairman Powell made the presentation he did, that they're still, even under this situation, they're going to be accommodative and supporting of the economy. But if we're coming out of this and we're expecting economic growth, we should expect interest rates to rise. Now, that will have an impact. One, it's a higher cost of borrowing for individuals and businesses. There's a discussion per the 1.6% crossing the dividend yield on the S&P 500 of alternatives to equities, certainly for potential income sources. And then valuations. We just walked through the exercise. Now, that exercise was going from high rates to low, but you could just reverse that and go from low to high. And then if the low interest rates are supportive of valuations, rising rates are going to be certainly a headwind. So something to keep in mind. It's like, what is not the expectation of higher rates, it's how fast are we going to get there? Just some notes on the stimulus. So I'm going to call unconventional monetary policy. Oops. Unconventional monetary policy. So that's what's happening to the Fed's balance sheet right now. And some of the discounts or rates they're paying on reserves from the banks. And we're going to compare 2008, 2009 financial crisis to 2020. Okay. Well, unconventional monetary policy in 08 and 09, that contributed about 9% of GDP at the time. So far, with everything that we know has happened so far, that's 13.7% of GDP today. So what they've done so far has contributed almost 14% to GDP. Fiscal policy, all the checks you're getting in the mail. 09, 5.6%. And this year, so far with what we know, 27%. And what I mean by what we know, the 1.9 trillion that's being discussed right now, and whether that'll get passed or not. So almost 15% of GDP back in 08 and 09 to 40% today. There's a massive amount of support for what's happened. 2008, the total financial support was 800 billion. Just at the end of last year, we passed 900 billion, a 900 billion stimulus at the end of last year. So far in 2021, we know that 1.9 trillion is being discussed. That's 2.5 times the entire 2008 response. And that 1.9 trillion is going to be greater than 5% of GDP just by itself. So a lot of liquidity, a lot of assets chasing performance, supporting valuations where they are, and potentially driving a focus on rates and inflation. The 2021 Townsend topic of the capital markets discussion. So money supply. Money supply is the money that's in your wallet, the cash register drawer, and your savings account. I know there's probably a more fancy economic way to say that, but essentially that's what this is. It's the money that we have to spend. And the money supply in the last 12 months has increased 26% with everything that's happened. That is the largest increase since 1943. From 2010 to 2019, that averaged 5.8% a year. You're like, wait a minute, James, how did you put $800 billion in monetary and fiscal policy into the market and the money supply only grow 5.8%? Well, back then it was a true financial crisis. You had every financial banking institution in the world shedding its balance sheet, condensing its balance sheet. So there was an offset to the money that was being dumped into the market. Just as a comparison, and I mean, these are numbers on China, so, you know, take it somewhat with a grain of salt. But so for China in 09 and 10, their money supply increased 23% each year. Inflation in China, July of 2009, was 1.8%. Frankly, right about where it is for us right now, where I think we're at 1.5. Well, July of 2011, that was 6.5%. Just what we know now, not the 1.9 trillion, just what we know now. 2021, money supply is going to increase another 12% from where we are right now. And that's 2 times the rate of all of 2010 on a per year basis, 2010 to 2019. So what does all this mean? I mean, we don't know when it's going to happen. We don't know the extent to which it's going to happen. We certainly know that inflation affects equity valuations. But there's really 2 ways to, at least from the equity market standpoint, 2 ways to battle the inflation headwind, and that is aligning yourself with companies with pricing power. Easiest example of something like that is when it's time to take little Susie and little Johnny to Disney World. I don't think the mom and dad are going to get away too well with not taking that trip because prices are up 5% into the park year over year. Very small example. But then also we got just frankly got to be mindful of the prices we're paying for the assets we're buying. For the same reason we had the discussion on interest rates and valuations before. So obviously, you know, if reviewing this presentation, you have any questions, please don't hesitate to give us a ring. trying to be mindful of time and knowing that there's a lot of topics to talk about, but we will come back in a few months and have a review again. So thank you for your time, and we'll talk to you soon. Thanks.